Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is October 21, 2024, and it is a weekly markets update. Let's have a look at the news of week 42 and see what are the next trends. Please check out my interview with Ilya Motorygin, co-founder of GG Trading DMCC, that was published last Friday. We busted some myths related to trading companies' role and place in fertilizer supply chain, and also confirmed some of them, so don't miss the jazz. Also, please let me know if you're attending Argus Europe conference in Athens this week. I will be glad to meet there with you. Urea prices are firm and continue increasing. However, market sentiment is quite mixed. From the one hand, market expects India to come back with the other tender very soon, perhaps even as soon as this week. From the other hand, increasing instability in the Middle East supports bullish sentiment. As per market analysts' evaluation, India needs to import at least about 1.5 million tons of urea until January in order to fill up the depleted stocks. Also taking into account the result of the last tender, most of the product will be needed for the West Coast. Demand in Europe is weak due to two main reasons. First, key markets like France, Spain, Italy were hit by heavy rains during past weeks, so the farmers are still harvesting corn and are not looking into purchasing yet. Second, high Egyptian urea FOB price was not digested by the buyers yet. So they stand on the sidelines waiting for the results of discussion during this week Argus conference, and also until next Indian tender results. Egypt hasn't sold since October 7. The last done deal was at $407 FOB. Offers from producers are heard at as high as $410 FOB, but no bids at this level. Black Sea FOB price moved up to $355 to $70 range, with no confirmed business though. No activity in Turkey. The least had cargoes of Iranian urea were heard at the level of $360 to $65 CFR. Iranian producers were targeting as high as $327 FOB last week amid tightening supply for November, but no actual confirmed sales were heard at this level. Middle East producers are committed until mid-November and will wait to sell to India. Thus, spot prices climbed more last week to the level of $380 to $85 FOB. Prices in the US decreased by $5 to $7 after a rally last week. NOLA FOB was indicated at $325 to $33. Supply remains tight for the upcoming month at least, but demand is also inactive, as next application window will be only in spring. Demand in Central and South America is weak. Price to CFR Brazil remained unchanged, around $380, with no fresh sales registered. Paper values cooled down for all benchmarks except Middle East. Egypt FOB marginally corrected downwards to the level of $395 for October and 2 months ahead. NOLA FOB also showed modest downward correction to the average of $331 for October, $334 for November, and $340 for December. Brazil CFR average demonstrated the most significant drop, $7 to $15, to the average of $375 for October, $378 for November, and $370 for December. At the same time, Arab Gulf FOB average increased to the level of 2 weeks ago, amid expectation of regional supply tightening due to the next Indian tender. Average values were indicated at $370 for October and December, and as high as $375 for November. Ammonium sulfate market prices are mostly stable, with demand rather weak, because the buyers are waiting more price direction clarity on the background of using urea. China FOB for standard product is indicated in the same range, $140 to $45. Granular product in the range $160 to $65. No fresh deals emerged. However, sulfate prices will climb soon, as market sees increase in nitrate prices. Cost pressure and increasing gas prices and firming ammonia price forced Yara to announce new price level for the Northwest European market for shipments in November and December, which is 10 to 12 euros higher versus previous one. Also, price increase for UK market for ammonium nitrate was put in place by Yara. Demand in the nitrate market in Europe upticks in certain countries, but in general is still weak. Also, there were no fresh deals registered in Brazil. UAN prices in key European markets surged amid urea price rally mostly, but the demand is not there yet, so no active sales is ongoing. In the US, prices remained unchanged and demand also weak. FOB NOLA offers corrected downwards by around $5 to the level of $225 to $30 for short ton last week. Ammonia supply in the East of Suez continues to be tight. However, further price increase is not supported on the buyer side. Thus, prices across the globe remained mostly stable. Major Middle East and North African suppliers are sold out for the most of November. Continuing maintenance at Milton plant tightens not only spot but also some contract shipments. These delays resulted in price increase for shipments to India to the level of $425 to $75 CFR, and still no spot volumes are available. Discussions about potential supply of Chinese ammonia to India are circulating, but Chinese product is priced somewhere around $500 CFR India and higher, and buying interest is not there yet. So supply limitations might result in production decrease, specifically of DAP. In the US, port of Tampa luckily avoided severe damage due to Hurricane Milton and was able to resume operations on October 12. Little impact on specifically ammonia infrastructure was reported. Demand for spot barges was low this week. Prices stayed at the level of $500 to $510 FOB for short ton. Trinidad producers report stable production capacity at around 80%. There is no confirmation regarding rumors about potential gas supply cuts. The activity in phosphate segment was limited this week. Euro buying is almost muted now. In Turkey, a tender for 25,000 tons of DAP as a raw material for NPK production was likely covered by Moroccan product at the level of $630 to $40 CFR. In Africa, there was activity again in Ethiopia, where EABC issued a tender for supply of 1,270,000 tons of DAP for shipment through November 24 to May 25 in 20 lots. It will close on October 28. However, there is not much faith that it will be awarded due to continuing financial problems of the government. Other than that, several buyers from East Africa purchased in total 30,000 tons of DAP from Milton at estimated $630 FOB Saudi for the first half of November loading. Milton also sold 40,000 tons of DAP to Indian IPL last week at the price around $643 CFR, similar level versus last week. On top of that, traders sold about 80,000 tons of DAP to several buyers in India at the level about $638 CFR for October-November loading. Still, India is lacking at least another 1.5 million tons or more to be purchased till the end of the year. India is also short of phosphoric acid, with prices indicated in the range of $1,050 to $100 CFR for Q4, but no price settlement is in place yet. China continues to stay away from the Indian market. Thus, and because of lack of demand from other places, Chinese FOB prices dropped last week to the level of $610 to $15 FOB. There is still no clarity regarding export policy for Q4. More information is expected at the beginning of November. In Brazil, there was no buying activity for MAP. Prices remain stable at $635 CFR. In the US, Mosaic reported that all plants will come back on stream in coming days after cleanup finalization after Hurricane Milton. No major damages were registered, luckily. While the market digested the results of hurricane, NOLA DAP prices increased by $8 to the level of as high as $590 FOB for short ton. There was no activity in MAP and TSP. Moving to the fundamentals. European natural gas futures flowed at the same level of around 39.7 euros per megawatt hour. Political tensions in the Middle East hasn't impacted gas price directly. In Europe, stable price level at the beginning of heating season was supported by a reduction in Dutch gas demand and relatively warm weather, but forecasts indicate a colder start to November. Europe's gas storage is 95% full, higher than average, but below last year's levels. Despite high storage, Europe will begin winter with 6 billion cubic meters less inventory than in 2023, mainly due to lower LNG storage. US natural gas futures fell below $2.3 per MMBTU, the lowest in 1 month, as increased flows to LNG export plants countered bearish forecasts of mild weather, which will limit heating demand through early November. For the week, natural gas prices fell around 11%, following an 8% drop the previous week. Traders are increasingly skeptical that extreme cold this winter will cause a price spike. Gas production in the lower 48 states declined slightly in October, and 2024 could see output decrease for the first time since 2020. Meanwhile, unseasonably warm weather is expected to keep demand low, with gas flow to LNG export plants reaching an 8-month high. Agricultural commodities future prices were all in red last week. Wheat futures decreased to $5.7 per bushel on Friday amid anticipated rains in key regions. With drought being a major global concern, rains are forecast across many of the world's wheat-growing regions. In the US, up to 2 inches across the central and southern plains, providing a needed boost to emerging winter wheat. In the Black Sea, showers across eastern Ukraine and western Russia improved planting conditions. However, perhaps too little, too late to reverse the worst crop conditions in recent years. In Australia, a storm is bringing rain to parts of the south. However, some areas still lack rainfall, leading to mixed wheat conditions. In Argentina, much-needed rain finally arrived to drought-affected wheat areas, and another significant rain event is in next week's forecast. From the other hand, support to the prices in the Black Sea might come due to intervention of Russian government, where the Russian Union of Grain Exporters has set the recommended export price of Russian wheat at $240 per ton FOB for October, $245 for November, and $250 for December loading. Corn futures also dropped to $404 per bushel, weighed down by ample supply. The USDA's estimate of a 2024 corn harvest at 15.2 billion bushels, slightly below last year's record but still among the largest in history, heightened concerns of oversupply. Compounding this, global wheat stocks exceeded forecasts, intensifying downward pressure on corn prices, as a lesser amount of buyers look for substitutes. Meanwhile, grain bagging has emerged as a popular storage option, allowing farmers to hold corn during this oversupply period and capitalize on carry returns. Soybean futures continued their downward rally, slipping to $9.7 per bushel. Key crop areas in Brazil have received significant rainfall recently, with forecasts predicting more in the coming week. Brazil's crop agency, CONAB, projects a soybean harvest of over 166 million tons for the 24-25 season, almost 13% increase versus a year ago. The WSDE October report shows output remaining on track for a record high. Additionally, the delayed crop progress report from NAS indicated that US soybean harvest was 67% complete as of October 13. That is 16% ahead of the 5-year average. Moving to the shipping industry. Containerized freight index stayed at the same level versus a week ago, with index being only 100 points higher now versus May level, from where the recent price rally started. The general tendency is the same that we discussed already during a couple of weeks. Costs for all destinations from China continue decreasing, while costs from US to Europe remain stable to firm. Perhaps we are close to the plateau, but let's see. The Baltic Exchange Rate Index collapsed by 233 points in a week. Declines in rates were across segments. In Capesize, the week started with optimism amid improved demand from miners in the Pacific, but at the middle of the week, the momentum reversed. In Panamax, the activity was subdued, and rates, unsurprisingly, drifted towards lower levels. In Ultra and Supramax segment, the activity in Atlantics was more or less high, which supported price levels. However, on the contrary, it was low in the Pacific. And tonnage availability grew. In Handysize segment, the performance was also mixed. In the continent and Mediterranean, there was not much activity, and rates were mostly stable. In contrast, the South Atlantic and US Gulf markets showed strong fundamentals and positive sentiment driven by robust demand for October dates and tight tonnage availability. There were two more news in the market that caught my attention last week. First, ADNOC completed its acquisition of OCI's 50% share in Fertiglobe. So now Fertiglobe fully separated its operations from OCI. The second one, Yara announced that it will transform the Tartar plant in Belgium, which would include closing the ammonia unit and shifting towards more competitive products, premium nitrate fertilizers and industrial nitrogen chemicals. This is connected with challenging market conditions in combination with high and volatile energy prices and maintenance costs, as well as more stringent environmental regulations and the need to accelerate decarbonization. Yara said it will replace locally produced ammonia with volumes from other sites, and after the proposed transformation, the Tartar site will produce 600,000 tons of premium nitrate fertilizers and 250,000 tons of high added value industrial products per year. To sum up, the market is eagerly waiting news regarding another Indian tender that is expected to emerge as soon as this week. For now, sentiment in urea is firming, especially in the Middle East, which product will most likely dominate shipments to India and where supply is already tight. China doesn't enter international market, so fundamentals support bullish trend are evident. Other nitrogen markets are stalling. Buyers would like to see market direction first. Phosphates demand from India continues to be strong, with some demand also arising in African markets, while demand elsewhere is subdued. Hurricane Milton luckily hasn't affected production of mosaic in Tampa Bay significantly, so all factories are expected to come back on stream in coming days. Warm weather both in Europe and in the US form bearish sentiment in the gas market in front of active heating season. Agricultural commodities future drop for all key commodities amid start of the rainfalls in the regions that were under severe threat of drought, as well as supported by ample production perspectives for 24-25 season. In dry bulk shipping, slow activity across the globe and shipping segments influenced quite a significant index drop over a week. So let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.